Now, this is a really nice summary of the Heckscher-Ohlin model, and it shows the effects in terms of opening up trade with the rest of the world on the US in this instance. So if you remember, in autarky, the US had a comparative advantage in wheat. So wheat was relatively cheap in the US and cloth was expensive, and the opposite way around for the rest of the world. When trade opens up, and by the way, I hope you've noticed that in all of these models, you're now seeing the second model. The first one, of course, was the Ricardian model. But in all of these models, when you set these things up, they're always set up as autarky to begin with, and then you open things up and you see what the effects are. So here we opened both the rest of the world and the US to trade between the two. We've already said that the US has comparative advantage in wheat and the rest of the world in cloth, so trade occurs. What does that mean, though, for the product prices? So that's the third row of this table. First of all, the price of wheat goes up. Second, the price of cloth comes down in the US. Now, the opposite occurs in the rest of the world. In the rest of the world, the price of wheat comes down, the price of cloth goes up. And how does the US and the rest of the world respond to the trade opening up? Well, as we saw before, the US specializes in the good in which it has a comparative advantage, which is wheat. So the US produces more wheat and produces less cloth, and the rest of the world produces more cloth and less wheat. The crucial step in the Heckscher-Ohlin model is this next step. So, what's going on here in each of these industries? If you think about it, if we move to from producing cloth domestically to producing more wheat in the US, wheat uses a lot of land and not much labor. So suddenly the demand for land has increased significantly. That means that the rent from land is going to rise in the US. Similarly, growing wheat doesn't require many workers, not nearly as many workers as producing cloth does. So there's going to be layoffs in the cloth industry, and there's going to be much less workers needed in the wheat industry so some workers may end up being unemployed. They have to change industries as well. That means that the price of labor or wages are going to fall in the US. Now, exactly the opposite is going to happen in the rest of the world. In the rest of the world, wage rates are going to rise and the rents are going to fall in both sectors because, of course, wage rates we're assuming are going to be the same in each country, in each sector. So what are the long run results here? And this is important because this is one of the things that the current administration has kind of stressed in its trade policy. But product prices should be equalized between the countries. If they're not equalized, they should be definitely moving in that direction. Why? Because initially wheat was cheap here, expensive in the rest of the world. The wheat price is coming down now in the rest of the world because we're exporting to the rest of the world, and it also is coming up in the US. So it means that wheat prices are going to tend to converge between us and the rest of the world, and the same thing goes for cloth. So who's going to gain and who's going to lose? Well, there's going to be net gains for both countries, but in different effects on different groups. So in the US, the winners are going to be the people who own the land, because suddenly there's a much bigger demand for land, because land is what wheat uses a lot of. Now, abroad, they're producing a lot more cloth, and cloth uses labor intensively. So there's going to be more demand for labor. So that's going to push wages abroad up. So the winners and losers here are, in the US, it's going to be US labor that loses, US landowners that gain. Abroad, it's going to be foreign landowners who lose, but foreign workers who gain. Now, it's no mistake that the author of this textbook used that example, because that is pretty much what we've seen in terms of what's happened with globalization. In other words, the opening up of countries to trade, to more trade. In other words, wage rates have tended to fall in the US and they've tended to rise elsewhere. Here's the long description of what I've just talked about, so I'm not going to go through that. This is the second page of that, and this is the third page of that. So you can look at that yourselves in your own time if you'd like. So what are the three implications of the Heckscher-Ohlin model? Well, there are three implications that are really classic implications from Heckscher-Ohlin. And this is why Heckscher-Ohlin was so important, by the way, when it first came out. First of all, the so-called Stolper-Samuelson theorem. Secondly, the specialized factor theorem pattern. And then lastly, the factor price equalization theorem. By the way, these are called theorems, but they're not really theorems. They're only theorems in the sense that they are manipulations of the model algebraically, which we can then show that this should happen. But in reality, they're not theorems per se. They are just suppositions, if you like. So let's take the first one, Stolper-Samuelson. It states that given certain conditions and assumptions, which we're not going to go into in detail because that's in the kind of nuts and bolts of the model, including the full adjustment to a new equilibrium, in other words, we're going to end up in equilibrium in the labor market in each country and in the market for land in each country, etc. An event that changes relative product prices in a country unambiguously has two effects. It raises the real return to the factor used intensively in the rising price industry. So in our case, it was wheat at a rising price. Therefore, the real return is going to be increased for the factor that's used intensively in the manufacture or the production of wheat. And if you remember, it was land. So the real return to land is going to go up. In other words, the rent from land goes up. It lowers the real return to the factor used intensively in the falling price industry. So in other words, in our case, for the US, it was cloth. So cloth has a falling price in the US. Therefore, the real return to the factor used, now the factor used intensively in cloth is labor. So it means wage rates would fall in the US. So that's the Stolper-Samuelson theory. We've kind of already done it as part of Heckscher-Ohlin as the results, but it was kind of a corollary, a conclusion that came after the Heckscher-Ohlin model was put together as a kind of an afterthought, if you like. Well, not really an afterthought, but an after conclusion. Factor ratio paradox. The effects of trade on factor use have their paradoxical side. The same fixed amounts of factor supplies get re-employed in the long run, but everything else about factor use changes. So in other words, the amount of factors used are going to get re-employed in the long run, but everything else about the factor use is going to change. In other words, when you specialize in wheat, there's basically labor that's got to come over from the cloth industry to the wheat industry, and it will all get employed, but it'll get employed at a lower wage in the different sector. In other words, in the wheat sector. In other words, the labor will be doing probably different things, like driving tractors, etc. Specialized factor pattern. The more a factor is specialized and concentrated in the production of a product whose relative price is rising, the more this factor stands to gain. In other words, if you have a comparative advantage in something where you have to have a qualification to work in that industry, for example, then that would really mean that the factors in that industry would gain a lot. Why? Because it would mean that labor from other industries couldn't simply move across. They would have to get some kind of educational qualification. Factor price equalization theorem. This theorem states that given certain conditions and assumptions, once again we're not going to go into a whole load of detail there, free trade equalizes not only product prices, but also the prices of individual factors between the two countries. In other words, wage rates should converge, and also rent should converge in the two countries. And that's even if the factors cannot migrate. Obviously, if there was free migration and there was nothing stopping anyone migrating anywhere, those wage rates in the labor market, for instance, should equalize. But in this case, we're not saying that anyone could migrate from the rest of the world to the US. That's not in our model. And yet, the prices are tending to equalize through trade. In other words, the wages are tending to equalize and the rents are tending to equalize. So in its extreme version, the factor price equalization theorem implies that laborers are all going to end up earning the same amount, and trade makes that happen. Same thing with rents, should be equal. So the next thing to consider is, okay, we got Heckscher-Ohlin and we now understand the model, hopefully. It provides some really important insights, and particularly the ones I talked about in relation to the current administration's trade policy. And, this was based on basically a hunch that Heckscher and Ohlin had. Bertil Ohlin was, as I recall, the student, and Heckscher was the professor, and Ohlin was a PhD student at the Stockholm School of Economics. So they were just talking, a PhD student with a professor, and they came across this idea about extending Ricardo's model. This isn't recently, of course. It's a long time ago that they did this. But anyway, it's an important model. It's an important way of thinking about what happens in the world. So the first formal tests of the Heckscher-Ohlin theory used the simple model of two factors of production, the one we've just covered, and US trade data. The tests failed. More recent tests recognize that more than two types of production factors are relevant to the Heckscher-Ohlin explanation of trade patterns. And really what this comes down to is that we got to really distinguish between, we can't just lump all labor together, because labor's different in the sense that there is blue collar workers and white collar workers. Blue collar meaning comes from the idea of workers that wear blue overalls in factories. So in other words, usually workers who do not have any formal university education. And white collar workers, usually those are workers who wear white shirts. This is where that term white collar came from, and they are usually people who do have university education. So in other words, the idea of contrasting skilled labor, what we call skilled labor, which is usually those who have some kind of vocational qualifications or a degree, and unskilled labor, those that do not. So we need to know the factor endowments of different countries. We need to know the international trade for various products and the factor proportions used in producing those products as well. So what are the export-oriented and import competing factors? So in this diagram, we can see the factor content of each $1 million of exports and the factor content of each $1 million of competing imports. So in the US case, you can see the unskilled labor is lower, but the skilled labor is higher compared to those produced abroad. Capital is lower here compared to the capital used abroad, which is higher. Farmland rents are higher here compared to the farmland rents abroad, which are lower. That would tend to fit, of course, with Heckscher-Ohlin, I guess. Mineral rights are higher abroad than they are here. So, unskilled labor comprises a relatively smaller proportion of US exports than US imports. skilled labour comprises a larger proportion, etc. Now, when they first tested the hexarolin theory, and I go back to that slide, this was a problem because if you look at the total amount of labour in the US compared to the total amount of labour used for the imports, you can see that US uses more labour. And so economists first looked at hexarolin and said, well, the US has a comparative advantage in machinery and equipment and stuff like that, and engineering products, etc. And yet we're exporting labor-intensive goods because you can see the factor content of what we export is high in labor. This does not fit with the hexarolin model. So what we had to do as economists, we had to break that down into skilled labor and unskilled labor, and hence why I talked just now about the distinction between those two things being important. Capital as well was a puzzle, because capital such as plant, equipment and inventories, if we're capital intensive as a country, we should have a lot of capital. So we had to look at things like human capital, that is training and education as well. So that's how we resolved this. So in this case, we're looking at factor content of each 1 million of exports, again, factor content of 1 million of competing imports. And this is specifically trading with Canada, not just the whole of the rest of the world. So let's have a look at this. So as you can see, Canadian imports are much more labor intensive, and they're much more labor intensive in skilled labor in particular. So it's not clear that this necessarily gives us much of an insight here, I wouldn't say. And this is one of the problems with the hexarolin model. It doesn't describe trade for two countries that are at a very similar level of development. So Canada and the US are examples of that. It's probably best to look at it in terms of a country that's developing and a country that's developed. Why? Because, Canada and the US are likely to produce very similar products because they're both of the similar stage of development. Next question he asks is, do factor prices equalize internationally? Obviously, this is unlikely to happen, and the factor price equalization theory is based on a number of assumptions, and some of those assumptions do not hold up in the real world. There are barriers to trade. For instance, just the cost of shipping stuff, for example, would cause prices to be different in each country, and that could, and that reflects therefore different factor prices as well. Probably the better way to think about the factor price equalization theorem is a weaker form of that theorem. And the weaker form is that international trade tends to make the prices of factors more similar, or move closer together is the way I probably put it. So for example, the rapid increase in real wages for factory workers in China. And, as a kind of a case study, this is a really important case study because it's behind what we've seen in terms of the benefits of trade to China. That has mostly gone to, of course, their workers. Benefits of trade to us have mostly gone to consumers because we've had cheaper goods. So one of the most striking features of the global economy is the rise of China as a trading force after it opened to international trade beginning in the 1970s. In 1980, China accounted for less than 1% of international trade. Now, it's probably accounting for more like 12 to 15%. Its trade has been roughly balanced, so the value of exports is roughly equal to the value of imports, even though both have been growing rapidly. For a country like China, though, hexarolin is a really good fit. Why? Because the types of products, it's got a lot of people there, the types of products it's likely to be exporting are those that are intensive in the use of labor. And that's what the hex roll-in theory would predict. So here's the exports and the imports of China through to 2016. You can see it's a very rapid increase. Thank you, and that's the end of chapter 5.